what are we going to cover today? So far, we have looked at the general fund, right? Some of the transactions. This class and next week after the exam, we'll take a look at the other two special type of funds. So we looked at general fund, we looked at special revenue fund, right? Now we're going to look at capital projects fund, and next Monday we'll look at debt service fund. And all of those are within the governmental funds, and we'll move off to something else, okay? So capital projects fund. The first thing which we want to talk about is this use of the term general capital assets. When you say, what is general capital assets from just plain capital assets? Well, the book makes the distinction that general capital assets are assets owned by and accounted for by the government itself. Okay? Bridges, buildings, roads, all kinds of assets, as opposed to just plain capital assets, which could be assets of the proprietary fund or fiduciary fund. So we'll go through that. Okay? So we'll take a look at, what the various issues are as far as acquisition, maintenance, depreciation, impairment, and disposition. By the time we finish this class, you'll all be experts at this stuff. And how do you finance these projects? We'll take a look at, give you an introduction to all this, the journal entries, the financial statements, which after having you seen the financial statements for the governmental fund and the government-wide, you'll say, gosh, is this it? Just a few lines? Yes, it is it. Just that's it, as far as the capital projects fund goes. And then we'll talk about this unique way of financing capital projects, which is special assessments. So let's start off with, what are general capital assets? First question to you. Do the capital assets show up on governmental financial statement, governmental fund financial statement? Where do they show up? Government-wide statement. Do liabilities associated, long-term liabilities associated with acquiring those capital assets show up in the governmental fund financial statement? Where do they show up? So it looks like long-term assets and long-term liabilities don't show up in the governmental fund financial statements, but they show up where? In the government-wide. So that's the first thing to remember, right? And so long-lived assets or fixed assets are shown, as it says, used by activities reported in governmental funds. Now let's start off with this. Remember I said to you, general capital assets are assets of the governmental funds, and capital assets are assets of the proprietary fund and fiduciary fund. I wish there was a better terminology, but when it says general capital assets, that belongs to the government. What it means is you don't mix the assets of the proprietary funds with the governmental funds. You keep them separate. Okay? So that's why it says what it does. So let's think about some of the assets. What kind of assets does a government have? What might it own? Well, it has a municipal building, right? That's one. Hopefully the land underneath it, right? Improvements. What other types of things? The what? Vehicles, computers, roads, bridges, all of this stuff is what? Part of the governmental assets. All right? So the government has a wide range of assets, ranging from land to building improvements, infrastructure, even computer software. They might have, like New York City has this, what is it, the 411? No, not 311? 311, I'm sorry. 311 software, which they probably spend millions and millions of dollars developing. That probably shows up on their balance sheet. So we have a wide range of assets. The question comes to you, which is, how do you buy them? How do you purchase them? Where do you get the money to purchase those assets? Hey, these are not like little computers which you budget annually and say, I'm going to buy 5 computers and I can buy it off my regular budget. These are like big things. How do you buy those? You borrow. So what happens is when we deal with long-term assets in government, there's another part of the story, which is what? Long-term debt or liability. The ideal thing would be to match the long-term liabilities with long-term assets, but it usually doesn't happen that way, okay? So that's what we're going to talk about. We're going to talk about how do you put these assets together, how are they accounted for, and this flow of money that goes on between the general fund, the capital projects fund, and next week between general fund and the debt service fund. So first lesson, once you finish building the building, does it stay in the capital projects fund? For those of you who read this. Capital projects fund is temporary. You build the building, as soon as it's done, you close the capital project. Counterintuitive. You think capital projects would have all your capital assets? No. You think debt service would have all your long-term liabilities? No. The debt service fund is used only to retire the debt, which is to make what? Periodic principal and interest payments. And we'll talk about that next week. So it looks like the capital projects fund is used during construction. Why do we do that? Why don't we just mix it in with the rest of the stuff? Why don't we just say, just use the governmental fund for building the $10 million building? Well, you're setting that, yes. You're setting that money aside for a specific purpose to do what? To build that bridge or that road or that building. And you know the people who lent you money want to make sure you use it for that purpose, right? So it's for a specific purpose, that's what you're doing. So now if you're building 3 buildings and you have 3 different bond issues, would you have 3 different capital projects funds? Yes, nothing wrong with it. You can have as many as you want. But you don't want to create many, many small ones. So if you decided to buy 10 computers, you don't want to have a capital projects fund for that. Okay? So that's something to keep in mind, is that that's how that's used. Now let's think about, yeah.
And would there be a different debt service fund associated with each?
Yes, it could be. And I'll come to that in a moment as to how that would work. So that's what I want you to do is I'm going to give you in the next 2 minutes, everything is in that chapter, because I want you to just think of the flow. So you're the mayor, you sit down with the CFO, said, you know, we need to put that building up. The CFO says, well, $10 million, we certainly don't have that money in the budget, but we can borrow. You as the mayor say, yes, let's go ahead and borrow, right? So what's the first decision? To do what you want to do, right? Now, before you can even make the decision to build that building, what else do you need? You need the taxpayers to say it's okay to do it, right? And that's called a referendum, and I'll talk about that later on, okay? So now the decision is made to build the building. What happens next? You go out and borrow money, right? So you get $10 million. Now, again, I'm trying to condense the entire chapter in these 3 minutes, okay? So you borrow money. You issue $10 million worth of bonds. How many have taken classes in finance here? Okay, just about everybody. And I don't mean to give you a lesson in finance, but unfortunately we have to just know a little bit of it. When the government issues bonds, everybody likes to buy bonds from the government. Why? Well, they think there's more security because they are backed by the full faith and credit of the government and by insurance. But what's the other thing that they like? Tax-free. They love that tax-free income. Because think about it this way. If you were earning 6%, okay, and you paid taxes on a bond, if you didn't pay any taxes on a bond which yielded 6%, would you buy that or a bond which sold at 7%, but you had to pay 2% in taxes? So that's that. So now you have these bonds which are being issued. Okay, so you sold the bonds, you issue the bonds. Now what happens is somebody's got to say what these bonds are going to pay. So your CFO says, you know, I'll take an easy percent. These bonds should pay the bondholders 5%. Okay, keep a simple example. She goes in and looks at the Bloomberg machine, which is right out here, and says the tax-exempt rate today is really only 4.5%. You're going to pay them 5%? You say, well, you know what? I don't know. I don't want the rates to go down and get a discount on these bonds. I want to sell them at a premium. Okay, now I know some of you might have this problem concept. I'm assuming you know the difference between a premium or a discount. Okay, premium is associated with a bond which pays a higher interest than the market rate, right? And discount is associated with a bond which pays a lower rate than the market. Okay, I'm assuming you know this. So now you get the premium. So now you have $10 million and $100,000 worth of premium. What's your budget for the project? Only $10 million. Do you say, oh, I got the premium, let's put it in this project? No. What you do is you take the premium of $100,000. You got to pay this bond back eventually, right? And you transfer it into the debt service fund because that's what's going to be used to pay off the bond. Okay. So now you've gotten the $10 million one. You've sent $10 million to the capital projects fund, $100,000 to the debt service fund, and what's the first thing you do? You sign a contract with some big construction firm to build that project. As soon as you sign the contract, what kind of governmental activity does that sound to you? What's the journal entry that you need to make as soon as you make a commitment? You debit encumbrance and okay, now I'm giving you this lesson in treat, so I'm going to go over this, but I want to give you what's happening, okay? So what do? You issue a commitment to the project. You encumber the number, right? Now, during this time, the construction goes on and things being built. The contractor finishes the project, but along the way, you tell the contractor bills you first $5 million, and the second one, payment of $5 million. You tell the contractor, you know what? When you bill me $5 million, you're not going to get the whole thing. And the contractor says, why? You say, until the final inspection, I'm satisfied that this project really comes to what it should be, I'm going to withhold a certain amount. And the contractor says, what amount? You say, well, usually governments like to hold 5%. So of that $10 million, you're not going to get the entire thing. You're going to get $9,500,000. And at the end, when I'm satisfied with it, and I know I don't have to spend any more money, if I have to spend any more money, I'm going to take it off that $500,000 I'm going to give you. That's the concept of retainage. Contract retainage that's being withheld. Okay? So now the project gets going, it's done, finished. When the project is finished, what happens? While the project was going on, it was construction in progress. When the project gets completed, the construction in progress becomes a real asset. And the real asset, once it's completed, the capital project fund goes away, but now you begin to make payments on the money that you borrowed, and debt service fund starts. That's the entire story. That's what we're going to talk about next. Okay? That's the way it works. I wanted you to know the flow of how things go. Now, I know I have the habit of trying to make things overly simplistic, but it really is, that's all it is. Everything else we see is a little variation of it, here and there, okay? All right. So we talked about the classification of general assets. Couple of things. Why do we need to know? First of all, we need to know for all general capital assets, we need to know what they are, obviously, and how to capitalize them. So for instance, land. I purchased land for $1 million. Is that what I capitalize on my books? What about other things like legal, closing costs, appraisal costs? What I'm saying is any cost necessary to acquire the asset has to be included in the cost of the asset. Okay? So if there are closing costs, there are appraisal costs, there are even sometimes land comes in and you have to clear it, set it, if there's some work that's needed, all of that is capitalized. Okay? Same thing with building. Improvements other than building, machinery and equipment, which we'll talk about, construction work in progress, which we just talked about. We'll talk about each one of these as we go along, okay? Now, how are capital assets acquired? This is the way it's done. I told you only one way, which was what? By borrowing, right? But that's not always the case. So, for instance, sometimes you see ever driving on a state highway, you see a sign, improvements made possible by the Federal Department of Transportation, $7 million, State of New Jersey, $3 million. See how it is, how that's done? So a typical project for the state is a combination of several things. It could be a federal grant, could be borrowing from the State Transportation Fund. So it's usually not one or the other. Sometimes you get it as a gift from an organization, a transfer from another fund, and we'll talk about this later, special assessment bonds or taxes. So the way we see it is use your own cash to purchase the asset, but that only happens when it's a small number. And when you do that, you don't need a capital projects fund. If you use your own funds to buy 10 computers, you don't need a capital projects fund. Second way, get a grant. Third way, what? Borrow. Right? Fourth, get it as a gift from someone. Right? And fifth, get it from another entity. Okay? So these are some of the ways we acquire. And finally, I'll talk about capital leases, which is a special classification of borrowing. Okay, so general capital assets are acquired from expenditures of general fund, special revenue fund, and capital project fund. Do you see proprietary funds? No. Do you see fiduciary funds? No. Governmental funds only. So what if I were operating a utility and I had to go out and buy a building? You don't need to go through capital project fund. It's all within proprietary funds. That's why I said to you, proprietary funds are so easy because they're just like a business enterprise. All the accounting is done pretty much the same, and you'll do pretty much what you will find in business enterprises. So, for a lack of a better word, this is called the cost principle subject to materiality threshold. What is materiality? Big term in accounting, right? Why do we use that term, concept of materiality? I'll give you, yeah. Don't use the word material. Okay. Okay. Yeah. And I'll give you I'll give you an example. Some governments say if the item is less than $1,000 and has a useful life of less than a year, we're going to expense the item. We're not going to bother at capitalizing it. Some governments have a threshold of $5,000. If the item is less than $5,000, forget about capitalizing. We're not going to capitalize the item. Because once you capitalize, what do you have to do? You have to keep track of the item, right? So, and you say, but in the government funds, you charge everything to expenditure anyway, but not in the government-wide statement. What do? You capitalize the stuff. And so in the government-wide statement, that's what this materiality threshold is. So whenever you go to a place in a government, you say, what is your capitalization policy? And they'll say, well, it has to be $5,000 at a minimum. And then you throw them in a loop, and you ask, is that for aggregated items? See what I mean? It could be for one item, or it could be what? A collection of items. So what most governments do is, it's kind of an interesting thing. They won't capitalize it, but they'll keep track of it. For instance, computers. They will still keep track of the computers, but they might not capitalize them. Okay? Just so that, they don't lose them. If you don't keep track, so they'll put a little tag. If you look at all the Rutgers stuff, there'll be a tag, hopefully somewhere on the computer saying where it is located and, who has the responsibility. Record donated assets at fair value on date of gift. Okay, and this is pretty straightforward. It is what it says, that you need to try to make an attempt at determining a fair value on date of gift. So if you receive something which is given to you, and it's difficult to assess the fair value, you need to get an appraisal done on that property. Okay, oops. So just as a review, general capital assets are capitalized, depreciation is calculated, and is debited to expenditures in the appropriate governmental fund. This is how things are done, and not very different from what you're used to, except for one or two cases, and we'll go over these. And these are some of them. First of all, we never depreciate land, right? When do we depreciate land? When would you be required to depreciate land? And this is kind of a tough example, but when do you think, all right, the town operates a dump for garbage. It was clean before people started putting garbage on it. When it was clean, it was worth $1 million. It can take 1 million tons of garbage. I'm just keeping it simple. First year, it accepts 50,000 tons of garbage. What should my amortization expense be? 50,000, right? You see that? What am I doing? I'm keeping this example very, very simple. That's where what land is using its value, okay? So a landfill would be one case. Now these okay, so your town owns a collection of really expensive art. Historical treasures, maps, stuff which is really, question is, do we capitalize it or we don't capitalize it? Well, GASB looks at it in an interesting way. What it says is, that artwork which you have, if you really take care of it, meaning if you preserve it, and in the event, if you sold it, whatever you get for it, you invest it in some other artwork, okay? You don't have to capitalize that artwork, because it is being used. Think about how it's being. It's used to display or whatever it might be. You're going to preserve it, and when you sell it, you're not going to use the proceeds to fill your budget. What are you going to do? Buy some other artwork. Now, what I want you to do is, it'd be a very interesting exercise. Go to the Metropolitan Museum of Art in New York, their website. or the Museum of Modern Art in New York, because you know they have priceless collections, right? Or the Louvre in Paris with Mona Lisa, okay? What do you think they do? Do they go out and try to figure out what their artwork is worth? Well, they can fall, and I'm not taking the right example here, but as long as it's for that purpose, you do not need to capitalize it. Let's take another example. The administrator, yeah.
In other words, as long as it's not for investment purposes, is that what you're saying?
First of all, towns won't invest in art for investment purposes. But if they inherited that and got that as a gift, just to display to the public, right? And they preserved it, meaning they took care of it. And if it were sold, the proceeds from it would be used to buy other artwork. They don't have to capitalize it. What I was saying is if you go to the Metropolitan Museum of Art, if you look at the footnote of what their capitalization policy for artwork is, it'd be very interesting to read that. Okay? Let's take a look at the third one, which is eligible infrastructure using the modified approach. Now, this is one item which caused a lot of problems. When Gatsby came out with the Standard 34, people were so upset at them for this specific provision, they wanted Gatsby to go away. In fact, some of them said they would not follow the standard. This was a very, very controversial part. Now, this is what Gatsby said. It said, first of all, think about what the infrastructure assets are. What are they? Infrastructure is roads, bridges, sidewalks, sewer, whatever you have, okay? And everybody said, what do you mean? We have to depreciate these things? Sounds crazy because these are assets which I know don't have infinite lives, but we consider them as infinite lives, meaning that road will be there many, many years from now on, okay? So Gatsby came up with this option. Have to capitalize it and depreciate it, or capitalize it and use the modified approach. If you use the modified approach, you don't have to depreciate the infrastructure asset. What does it mean? It means you have to meet these conditions in order for you not to have to depreciate. What is it? First of all, you have to have a really up-to-date inventory of all your assets, all your infrastructure assets. Then you have to hire an engineer to conduct an assessment of the assets and summary of the results using a measurement scale. So you have a major highway. You have to get an engineer. Okay, I want you to give me a scale from 0 to 100 where that highway stands. You say, it's 75. 3 years later, the engineer is hired back. What's the scale now? It's 50. Uh-oh, trouble. Sounds like trouble. Why? Because you did not maintain the asset at that service level. So what does modified approach says? It says you must maintain the asset at the assessment level when you started it off. If it was 75%, you got to maintain it. Now, any cost to maintain that asset can be expensed. The only stuff that you capitalize is something which does what? Adds to it, okay? But if you were to just maintain the assets, you can expense it. And this is estimated each year the annual amount needed to maintain and preserve the asset at the established condition level. Now tell me, why do people get really excited about this? People in the public world. No, why did they want to use the modified approach because they certainly don't want to use the depreciation. Okay? They want to use the modified approach, but why do they get so excited? They have to maintain these roads at a certain service level, which means what? Work. Now tell me one thing, in your experience, looking back 10 years Do you think the roads are in the same condition as they are some of the bridges especially? There's a report, and I have to give you the name of the report, which did an assessment of all the major infrastructure assets in the country. And they, you know what the grade was, the average grade was? I think I wrote it down somewhere. It's called Report Card for America's Infrastructure. Report Card for America's Infrastructure. You know what the grade level was? A D for most assets. The only assets which got a C were parks and recreation. Now, I'm not saying this is generally. I'm not saying that's in New Jersey, but generally. Okay? Pretty bad, right? So, what is modified approach then? Modified approach is in lieu of depreciation. Now, there are people who use depreciation too. I'm not saying there aren't people who do that. But most states, and actually when you do the CAFR exercise, that's one of the things. You're going to try to figure out if they're using the modified approach or not. Okay? And it has to be shown in their report that they are using the modified approach. There were a lot of, it was very, very difficult for GASB because, you know, the whole concept behind capitalizing and keeping track of assets is based on what? You can't steal infrastructure. You can't sell it, right? It's not like an asset that can be taken away by someone, right? And that's what the critics were saying, that, hey, wait a minute, what are you talking about here, you know? And then obviously the government has to document that the assets are being preserved at or above established levels of condition. So far what you have learned is that you need to know what things are capitalized. You need to know the rules for art and art collection. And 3, the modified approach. Now let's take a look at some simple journal entries. They purchased office equipment for the mayor's office and paid $50,000 cash from the general fund. Okay. Anything complicated here? The only thing I can think of here is that they probably budgeted this in their annual budget because it sounds like a small expenditure, right? They probably didn't have to go out and do that. Same exact thing, but what? Remember the difference, expenditures and equipment. Okay. Let's take a look at capital leases. Okay, so remember I told you there were various ways to acquire assets. One was what? Pay cash for it. Another one was get some money from someone. Third one was to borrow money. And there's a fourth one, which is using a capital lease. What's the difference between an operating lease and capital lease? The what? Operating lease is what? It's expense up front, right? It's treated like a rental, right? And with a capital lease, what do you have to do? Well, it's basically what it says. It's what? Capitalized, right? And do you all know the rules for what they are, right? It has to be for a certain period of life, which is what? And what is the present value of the lease payments? Have to be at least 90%. Boy, you guys are good. Okay. While I'm trying to figure this out. Okay, what's the third one? It's you have to, at the end of the lease period, you're given the option. Okay, I don't have to say anything more. All right. Good. Good. All right. So you know what that is. The point is that because capital leases are long-term, right? It's a long-term liability. It certainly won't show up in the government, in the general fund, right? It will show up where? In the government-wide statement. And we'll take a look at our capital lease here. So Notice, instead of a liability, what this becomes is what? Other financing source. Not revenue, but other financing source. Okay? Very important within the special revenue fund. If I put general fund here, would it have made a difference? No. General fund and special revenue funds are like brothers. They all follow the same thing. One is specific purpose, but they both use budgets if they're required. They both use encumbrance accounting. Everything's very, very similar, except for the purpose itself. So other financing source, except you will always have the general fund, but not special revenue fund. You can't have government financial statements without the general fund or current fund. You'll always have it. Okay? So this is the transaction, and this is the transaction on. Okay, let's take a look at this problem 5.5. Where is that? On page 205. Okay. Okay, since you guys are good at this stuff, let's see how we do this with this. I'm sorry, 5.5, right? Okay. Yep, here we go. All right. All right. So the first question is, so the cost is $12 million. When it's built, has an appraised value of $13 million, has a life for 40 years, 30 payments of $847, and looks like the first payment has to be made right at the start. So using the criteria, determine whether the Crystal City should consider this lease agreement as a capital lease. All right, let's do a little math. What's the math here? Let's calculate the present value of the lease. $847,637 plus how many payments? 29 payments times what? Actually, you know what? We have the present value factor. They gave it to us already. Okay. Right? Everybody with me? Right? Okay, good. So what does that give us? What's the number? 12.6 million? 12.6? No, I think it's, somebody calculate that number for me. Should be like 12 million something. Okay. All right. That's the number, right? So what's the test here? Present value has to be what? 90% of the fair value. So what do I have to do? Divide this by, what's the fair value? And what's that number equal to? That number is probably around 95 or something. Okay. Huh? Right? So do we meet the test? What's the other test about the estimated useful life? 75%, right? How many years do we have? 30 divided by 40 is equal to 0.75. So we're good there. All right, so that's that. Now the second one. Provide the journal entries the Crystal City should make for both the Capital Projects Fund and governmental activities. Okay, who's going to give me the entries? This is pretty much the one that we did before, right? So expenditures are what? Cash was what? 8. And then the difference is what? How do you book that one? Other financing sources, lease, and that would be everybody see that? Okay, just the same example as we looked at before. And what would it be in the other one, the governmental activities? Would it be expenditures? Building of and same thing, cash. And what would the other capital lease obligation payable? No, this. Boy, you guys are too polite. You should have told me that. I just noticed that, you know. So what would it be? I'm sorry, whatever the total is, what? No, wait a minute. No, this should be 11. Yeah. I better do this math right here. Okay. What is this, 11 million what? What is it? I'm sorry. 11 million? Thank you. Okay, that's what that is. I had the math wrong. Yeah. Good. Yeah, those numbers are too big for me to try to multiply here. Yeah. Yeah. No, the other financing source on the Capital Projects Fund shows up in the statement just like a revenue, underneath the revenue.
I'm confused about that. You say the long-term liability didn't show up in the fund statement.
No, but they don't. This is not a long-term liability. This is other financing source. Okay? This is long-term liability in the governmental activity statement. Other financing source is not a long-term liability. It's remember I told you when we looked at the statement initially, you saw the revenues, expenditures, and then the third category was other financing sources or users. Yeah. Everybody good with that? Right? Okay. Let's go on and see the next one. Is my math okay there? All right, good. Thank you. Okay, let's take a look at the something called the capital asset disclosure. And what we're going to do for this exercise is, yep. The what? Capital Project Fund, yeah. And yeah, government activities, yeah. All right, let's take a look at the capital assets disclosure now. This is an important piece. The schedule has to be included as part of your financial report. And this is where all the details shows up. This is on page 173, yep. First of all, notice what it says. Primary government, okay? Notice the columns across. Beginning balance, additions, subtractions equals this. Additions, sales, disposals, whatever that's here to give us this balance, right? Notice something else. Capital assets not being depreciated distinguished from capital assets being, see the two categories, right? Notice each one has its own line here, shows you that, and then the accumulated depreciation shows up for these. So notice the format of the disclosure itself. And also notice as I go down that the business activities have their own thing. Okay? So we don't combine this with this. Separate disclosure. Okay? And after you've done this, what you need to do is you need to show how you are allocating your depreciation expense to the various functions. This was the depreciation expense for all the governmental activities. This is how you have allocated it. Okay? You need to do, because you know where this is going to show up? It's going to show up in the general government functions. We don't have a separate line for depreciation. What happens? Depreciation goes and becomes part of that functional expense. So this is part of the disclosure. Now let me see if you really understand this. Let's go to page 205 and take a look at an example. Take a look at this. So what's wrong with this disclosure, if anything? Anything wrong with this thing? Okay, so what David is saying is that shouldn't you have each of these assets, building, equipment, construction work in progress, as separate lines? Yep, you should. You can't combine them all together. Each of these, land, we don't have the detail on it. It's all combined together. That's problem number one. Any other problem? Well, let's just assume this is only the government, okay? Let's just assume that. What else? Any other problem? Yes, accumulated depreciation should be also broken down by each asset. What else do we have that doesn't look right? How about this? Yeah, it doesn't show what? Addition and deletions. What does it show? Just change. That's not too good. You need to know what the components of that. That's number two. Anything else? And since this is the complete capital disclosure, remember I went to that other page? What does it also not show? the allocation. So those are the three problems. It doesn't show the allocation of the depreciation expense. It doesn't show the change in its component. And it doesn't show each of the assets separately or accumulated depreciation separately. Okay, does the county use the modified approach to account for infrastructure assets? How do I figure out? Do you think they do or they don't, based on what you see here? Read the title carefully. So that means when infrastructure is not being depreciated, what does it mean? They have adopted what? The modified approach. So what she said was that since infrastructure asset was in this not being depreciated, it meant that they were using the modified approach. And it's true. If it were being depreciated, then they would not be using the modified approach. But since it's not being depreciated and is shown here, they're using the modified approach. All right, the next one is just pure math, which is what percentage of the useful life of the depreciable assets remains? Well, what's the depreciable asset amount equal to? What is it? 15,068,000, right? That's the amount, right? What's the depreciation? Minus 4,022,000, right? This whole thing divided by 15,068 tells us what's left, right? No fancy math here. If you had an asset which cost $10 and you had accumulated depreciation of $3, what's left? $7, right? So what's the expected life you've got left? 7 years. Same exact example here, okay? And what does that equal to, by the way? It's probably like 70% or something, 73%. Everybody got that? Okay. Okay. We'll take a quick 2-minute break just in a moment. Let's just finish this up. The final thing that you need to keep in mind is what we talked about before, which is if it is to maintain it, you expense it. If it's to, if it's to add to it, obviously you're going to capitalize the cost. And obviously it would, it requires judgment to determine whether an asset has been enhanced or not. Actually, let's take a break and then we'll come back.